Hello and welcome to Forex.Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing Types of Markets Part 1. The Forex exchange market has a daily turnover of $5 trillion, and which has the largest amount of market participants than any other asset class. The Forex market has seen continual growth over the years, but it started evolving into what we have now after the advent of the Bretton Woods system, which was a monetary policy where countries agreed to peg their currencies to the US dollar, and where the United States agreed to redeem dollars for gold. This system collapsed in 1971, which led to the free floating of currencies on the free market that we see today. Forex trading platforms began to emerge in the 1990s. However, it wasn't until the development of the internet, trading software, and the emergence of Forex brokers who offered trading on a margin, which started the growth of retail trading in the Forex arena. Foreign or international currency exchange rates display how much one unit of currency can be exchanged for another currency. Typically, exchange rates float up and down, and where the value of one currency against another is traded based on a multitude of factors. This includes the strength or weakness of an economy, interest rates, gross domestic product, and political factors including war. Currencies can also be fixed to another, in which case they still float. However, they move in tandem with the currency to which they are pegged. All currencies are traded in pairs, and where traders simply look for strength of one currency against the weakness of another in order to make profitable trades. While this is not the easiest thing to achieve in such a volatile market as foreign exchange, software trading platforms that offer great technical analysis tools with the study of recurring chart patterns on screens has completely changed the dynamics of trading within an asset class, and so, technical analysis trading has driven the exponential growth of the Forex market. The types of people who trade the Forex market are hedge funds, asset managers, central banks, sovereign wealth funds, financial institutions including currency speculators, and retail traders who all try to make potential profits from currency fluctuations relating to global economy. In example A, we can see how the euro is quoted first against the USD because the euro has a greater value than the US dollar, in which case it is quoted as the base currency against the quote currency. The same applies for all currencies. Although it is common sense to believe that, for example, a country such as the United States, with all of its wealth and power, has a much greater financial foothold over countries such as New Zealand or Australia and Japan, there is almost an unquantifiable amount of economic variables that formulate the value of one currency against another, and this is why you'll find that one of the idiosyncrasies in the Forex marketplace, where holders of United States dollars might quickly sell those in order to buy the yen, Australian, and New Zealand dollars, simply based on rumors, speculation, and chart patterns. It is because of this that Forex is the most volatile of all asset classes with constant price movement. Here in example B is a market watch price board showing many currency pairs and where the fluctuating exchange rates are expressed as bid and ask. If a trader believes a particular pair is going to go up, they will accept the bid price and execute their trade on the trading terminal. And if they think the value of an exchange rate is going to go down or depreciate, they will accept the prices quoted on the ask section of the trading platform. Example C is a chart of the USD CAD pair on the 4-hour time frame. Traders look for patterns on their screen such as swing highs and swing lows in order to try and gauge the strength of one currency against another. And therefore, in this chart we can see that after a swing low, the US dollar began strengthening against the Canadian dollar, all the way up to the swing high where we met some resistance, and then the Canadian dollar began to strengthen against the US dollar as price retreated away from the swing high. When trading in currency markets, traders buy one currency and sell another. In our example, traders began buying the US dollar and selling the Canadian dollar when price moved up and away from the swing low, and when this continued all the way to the swing high. Traders choose the Forex market because there is so much activity. There are many currency pairs, and because the market is often extremely volatile, it presents many trading opportunities. And because of the continual change in economic circumstances of countries, and continual news flow pertaining to economic data, this market has become the most liquid of all asset classes. Because of tight spreads and cheap execution relating to trading within the Forex market, and small outlays in capital which are needed to fund trading accounts, it makes absolute sense to consider Forex trading as a great business opportunity. If you enjoyed the video, please like and subscribe, and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.